Welcome all, and thank you for joining today's live NAB economic update. My name is Chris Thomas, and I'm the Executive of Commercial Broker and Equipment Finance Sales at NAB. I'd like to commence by acknowledging the traditional owners of the lands in which we meet today and pay my respects to their elders, past, present, and emerging. Today we have over 1,000 of our valued commercial broker partners and equipment financing customers participating in today's event. We also have some of our media partners here as well. On behalf of NAB, I wanted to thank each of you for taking the time out of your busy schedules to attend. Importantly, I wanted to also thank you for your valued partnership and custom. Well, if you believe that we have been riding a roller coaster since the start of the pandemic back in 2020, then stay strapped in as the thrills and spills just keep coming. A new federal government, record low unemployment, business that continues to drive the post-pandemic recovery. We also have war in Ukraine, global food and energy disruption, and the big dipper, inflation. To make sense of it all, it is again my pleasure to be joined today by one of the most prominent voices in financial services when it comes to the economic commentary and insight for us all, in Alan Oster, NAB's Chief Economist. Just before I hand to Alan though, I just wanted to address some housekeeping, if you will. This session will run for 45 minutes. We will enjoy a Q&A at the end, so please use the toolbar that you have in front of you to load questions into the Q&A function, so we're ready to go for when Alan concludes his presentation. But without further ado, let me please hand over to Alan. Welcome, Alan.
Thanks, Chris. It's a pleasure to be here and to talking to all our clients. As you say, interesting times. What I'm going to do is run through a presentation, and if people want it, Chris, I'll send it to you, and anyone who wants it can have it. But yeah, it's certainly interesting times in terms of what we're seeing. So what I'm going to do now is quickly go on to screen share. And hopefully you guys can see all this. Okay, all right. So talking a little bit about COVID, supply chain, higher rates, and the only good thing I can say is government doesn't really matter in terms of what's really happening out there. But let's talk to start with on the Australian economy. The world economy. And I must admit, I'm getting slightly worried about the world economy in a number of ways. There's three that we're sort of identifying. Number one, China. And China's still got its problems with vaccines and essentially the fact that they don't really work very much against Omicron. So they keep locking things down. We've now got growth rates around 4% for the year. And I think there's downside risk on that. And it doesn't help in terms of containers and all that sort of supply side problems when the port of Shanghai is closed down and their container throughput is down 20 to 30%. So that's something that sort of still worries me in the near term. In the next 6 months or so, I'm more worried. I'm also worried about Russia and Europe. Now that they've essentially, Europe and the G7 have essentially stopped oil coming out of Russia, which hurts them a lot more than gas. You got to wonder what the Russians are going to do in response. And I suspect if they wanted to cause a big issue, they just say no more gas and they'll wait until winter. And so that could cause a lot of problems for countries like the UK. The Bank of England's already talking about a potential recession at the end of the year, and also for Europe. Also, Japan's not doing really great at present. The third one, which I think is more important in a lot of ways, is the US. And it's also about central banks, basically. I think they're really increasing rates pretty aggressively. So we think the Fed's going to go, at least in the next two meetings, 75 a go. So they've done 175, they'll do 3 in a row, we think. And we think by the time of the end of the year, you'll be about 3.25% to 3.5% for the federal funds rate, which is quite an aggressive increase. Okay, you can say it's still currently at levels that are low and inflation is very high, but the rate of increase is really quite significant, and it will have an impact. The graph on the right-hand side there is interesting because it's just a model that we run. It's got a whole pile of things in it. Some of that includes oil prices and currencies. And if you look carefully, right at the end there, in the middle of next year, it's producing zero growth for a couple of quarters in a row. And so yesterday we decided if you can't grow your economy much for an extended period and unemployment's going up more than 0.5%, that's a recession. Forget about 2 quarters of negative growth. Think about, can you grow your economy sufficiently in this sort of environment? And even with some growth in the beginning of the year, you still get around 1% at best for GDP and 0.5% increase in unemployment. And by the time you get to 24, we think unemployment could be close to 5%. It's currently 3.6. So we're quite concerned about what that actually means in terms of the flow-through implications for the world economy and also for us as we go forward. And I'll talk about that in a minute. Okay, so these are just some numbers, and you can see we've got from 3.4 down to 3.2 to 3.1. The long run average is like 3.5. And you're looking at the top of the charts here, you get something like 1, which is really not very good and not much better the year after. So we're quite concerned about a couple of years of below average growth and what that means then to Australia. So if I turn on to Australia, I've got some good news for you. We don't look at all like that. So if you go back to the lockdowns last year, the December quarter numbers basically recovered all the losses. The March quarter numbers were quite strong. And, you know, we're now talking, you know, around moderate growth as we go forward. What the actual numbers did is they actually brought forward a little bit of growth in the first quarter, essentially because what was happening was people were worried about supply chains. And so there was a big increase in stocks in that environment. As we go through the course of this year, we see growth from December on December of around about 2.7. So what's that mean? Well, year average, it probably means it's because you had strong growth at the end of last year, it's probably around 4. We do worry that what we're starting to see, and I'll talk about this in a little bit more detail in a minute, we're starting to see in the end of June some signs that the consumer is not spending as much as we would have expected. But in the near term, you know, you still get strong growth in the first quarter, but it's quite a slowing. And if I look back to where we were 6 months ago, we were expecting the economy to go like 3.25%, and now we're talking 2.7. When we look at 2023, we see 2 things happening that are important. So that through the year growth rate of 2.7 goes down to about 1.8. 2 things matter. 1, the global economy is slower. 2, interest rates are going up. And we'll talk about more on interest rates, but broadly, we see interest rates probably for the next 2 meetings. You've had 150, you have another 2 lots of 50, and then maybe another 25 around the end of the year. That gets us to 210. Markets are way higher. They're like 3.5 to 4, but we don't think that's likely. And the Reserve Bank governor admitted this morning that he didn't think it was likely either. But one thing that you do see is you don't see any liquidity impact of these increases of rates until early to middle of next year. And so that's when we see a period where essentially things are softening. We still see business investment quite strong. Obviously wage and prices. Prices in particular are really strong. So we can see headline inflation getting up above 6, maybe 6.5. RBA is talking about maybe 7. The core inflation numbers, which is the trim mean, is currently 3.8. We could see it getting to 5 soon, i.e. by September quarter, and essentially staying there for a couple of years. So we're not seeing, so we'll get back to about 3 by the end of 23 and into 24. So supply chain problems are there and going to stay there for a while. As I said, I think the Reserve Bank is probably going to be aiming to get it to around 2.5 in 23, maybe a bit higher, maybe a bit lower. It really depends on the data, but they don't need it really low rates anymore. And so what we're looking for in particular is how does the consumer behave in this sort of environment? And as I said, in the near term, it's not about liquidity. In the near term, it's about panic. Next year, it's about liquidity. All right, so if I then just move on to the currency, and I always say if I knew what the currency was going to do, I would have been retired a long time ago. Our models sort of say it should be 78, that sort of sense, because commodity prices are very high. It's sitting around 70 cents, and we've got them 72 by the end of this year. And then we sort of assume it goes back up next year to something more around equilibrium. But at this stage, you know, people are worried, they get scared, they run home to the Fed in that environment. And so therefore there's a bit of a premium on the US dollar, and also people don't like the idea that China's weak. So now I'm going to run through some of the data that I normally show you guys in terms of what we're seeing. The data I'm going to show you in terms of our own data is as of the 11th of June. So as of tomorrow, I'll get it as of last Saturday. But this was also showing us the first week post a 50 basis point increase. So what are we showing here? We're showing seasonally adjusted. Black is consumption, grey is hospitality, and red is retail sales. So this is a pattern that says things have been quite good, although around January it wasn't so great. And then if you look right at the very end there, there's a bit of a slowdown, but it's only for a couple of weeks and it's still at pretty good levels. So it does worry us a little bit. These are sort of like trend graphs. When you look at the raw data, you see the fall a little bit more, particularly Western Australia, Queensland, South Australia, and the ACT. Victoria is probably doing as good as anybody, and New South Wales is a little bit in the middle of the pack. So we're watching, basically, is the bottom line, because we don't think it was a liquidity thing. It may be just people are saying, I can see rates are going to go up. I can see my house prices going down. Maybe I should just keep my savings and try and not spend as much or change the composition. And within this data, without going into the ins and outs, we're seeing more in petrol and we're seeing a lot less in discretionary retail. And so that's something that we're going to watch. The other thing that we watch pretty closely is the revenue flows to business bank clients. So sure, it's only NAB, but it's 30% of business. And the dotted line there is basically the 2019 seasonal pattern. The black line is last year and the red line is this year. So as of the 11th of June, sure, we had some weakness in the last week or so, but it's no more than seasonal. And so if you look at that, you see some quite reasonable numbers for overall and reasonable numbers for SMEs. It's going to be a test because we're going to see in the next couple of weeks the end of financial year effects where these things should go up. The other thing we sort of see when we're looking at this is mining is doing really well, but we're now seeing a lot of the domestic part of the economy doing okay. So this is manufacturing, there's transport. If you look at the next slide, which is hospitality, that's doing pretty well. Retail is sort of okay, but not great, is sort of the bottom line in our internal data anyway. And then when we look at construction in our data, it's okay, but so far we've been lucky to essentially avoid some of the big property developers have got themselves into trouble. So we sort of don't take a lot of solace in that. So retail is okay, but I think people are starting to think about what are they going to do going forward in terms of are they going to spend as much, particularly in discretionary retail. And, you know, that can flow on to other areas of the economy as well. And I'll show you some data later on about some surveys that we've run recently about where you're going to spend your money. A few areas that are still not doing well. Healthcare. That's elective surgery, still have issues there. You can't get enough nurses, etc., etc. And arts and recreational services doesn't seem to be doing that well at present. So the sort of big picture is consumption has been really good, but it's sort of slowing. Maybe it's only in the last week or so, but I wouldn't like to see that repeated for a while. It would be an issue about the September quarter, not the June quarter. And the revenue data, some of it's patchy, but generally the domestic economy is still doing really well. And I'll show you in a minute, the level of the labour market is still very strong. So we can actually tell how many people who are NAB customers being paid the dole. And we do it as of last week. So we get a good feel for what's happening there. The other thing we look at a lot is our business survey. And so we've got a business survey for May. The blue line is business outcomes. The green line is forward orders. And you can see, compared to long run averages, even in May, things were really good. Red is confidence. Now, it's about +6, which is sort of long run average. So confidence has come back a bit, but I'll give you context. That graph goes down to -60 and in New Zealand is -50. So the confidence in Australia is still pretty good and the outcomes are very good. When you look at things like capacity utilization, you can see that, you know, in red, which is the deviation to trend, and blue is the actual. But, you know, you lost 10% of the economy in the first parts of the pandemic, and now it's recovering and it's quite strong. So capacity utilization says that, you know, things are strong. They probably would be even stronger if I could get my inputs and do more production. In terms of which industry, blue is actual outcomes, red is confidence. Miners are doing well. Retail is doing well, although they're not that confident as we go forward. And then you look down the bottom, which sectors are doing poorly? Well, construction is not doing great because they're saying their profits are being killed. So this is the story I'm sure you've heard about, where you've got a lot of builders with fixed contracts, and then their input costs have gone through the roof. And so they're trying to buy the contract back. They're threatening that if they don't get an extra money, which they're not legally entitled to, then they won't finish the contract and you won't have your house built. So there's a sort of, that's an unusual situation. And then you look around the middle, and again, if you look in the middle there, wholesale is a leading indicator. So it's good now, but the confidence is not there. It's sort of the bottom line. So it's pretty mixed in a lot of ways. And if you look, you know, which states are doing well? Well, Queensland was recovering really strongly post the floods, and Western Australia is doing okay. Victoria's a little bit softer, and so is Tassie. But generally, it's a story that says the economy at present is doing okay. This is the one that everybody worries about. So this is purchase costs. And so in May, if we look at the purchase cost and we think of it as a quarterly rate, they're saying purchase costs are going up 4% per quarter. So think, you know, 15, 16% per annum. And in construction, it's more like 20. And what we're seeing in product prices is that we see big increases, and particularly what we're seeing recently is big increases in retail product prices. So some of this is now being passed on to the consumer, and that I think is going to cause grief. And you all know, and this is our expectations about inflation. So we've got a headline at 6.4, and we have it around about December. And the reason you have it in December is basically because that's when the petrol tax reductions disappear. The core level, which is the blue line, is currently 3.8, and we think it might get to 5. Now, if you look at that, you don't really get back below 3% until you're essentially in 2024. So it says you're still high for a really long time. and the Reserve Bank is obviously trying to get that down. And the way it does it is it slows the economy. That's basically the mechanism. And once it's slowed the economy, unemployment will be higher, and the ability to get pay rises will be less. So that's the mechanism, and it does take at least 18 months or longer to actually have that impact. A couple of comments about is now a good time to buy a house? And we've actually got a June quarter which dropped. So that graph on the left-hand side, we've got investors, good time to buy a house, and we've also got owner-occupiers, and those numbers are around about 24. When we did the June number, which I don't think we've actually put out, it's like about 18. But do you intend to buy a property anyway? Hasn't changed, and it didn't change much in June either. So there's a bit of a demand still out there because people see it as a good investment in the medium term. But as you put up rates and signal you're going to do more rates, you get some turning points. And so this is the 6 months annualized growth in house prices. And you can see, particularly in places like Sydney, Melbourne, house prices are starting to go backwards. The two markets there that are not yet doing that are basically Queensland or Brisbane and Adelaide, and it was up until recently Western Australia as well, but that's started to come down too. We have and expect to see further falls in rates as we go forward, or in house prices as we go forward. The numbers that we've talked about, I don't think we've said this publicly. We previously expected house prices to go up because of the momentum in the first half of this year by about 2.5%. If you ask me now, I'd say minus 2.5% and minus 15 for next year, rather than minus 10, which is our public numbers. So we still see that, so you're talking 17, 18%. But if you look at the red lines, you see that, they're up, 23% in the last 18 months. So you're sort of reversing what we had in terms of what is happening out there. And so the consumer, sure, there'll be problems in the tails. So for example, if you've bought recently, you've got a one income family, you're on average weekly earnings, you might have a problem. And just to give you context, if you're on average weekly earnings and the cash rate gets to say 2 to 2.5, and you're getting paid a wage increase of 4.5%, which is what the national wage case came up with the other day, all your wage increase get wiped out by interest rates. And then you've got electricity bills and all that sort of thing to pay as well. And so one's interesting. I know everyone says we've got a lot of money in the consumer space, and so therefore they'll spend it and things will come down. We agree with that. But when we actually look at, if you look at the black line is the cash flow. So the difference between that and the savings rate is we basically take out the top 15% of the income distribution. So what I'm saying to you is most of those savings rates are actually held by the top 15% of the people. On average, the guts of the economy is spending as much as they're getting at present. So that last observation is May. So that just makes us feel slightly nervous, and people are worried about cost of livings, and they're going to be talking about what are they going to do unless they get big increases in wages, et cetera, and then the wages get taken away by interest rates. So one slide that we've actually got, so we go out and we talk to 5,000 people each quarter, and we ask them questions. One of the questions we asked them in June, this was after the first rate rise, but not the second one. What are you going to change your spending patterns in the next 12 months? There's some big swings there. Now, they may be wrong, and that's maybe not what they're doing. But, if you look at the top line there, the ones that they sort of going to reduce a lot is holidays. So maybe they're not going to do their holidays anymore. If you look down the bottom, school fees also down a lot. Private health, don't like that as much. And home renovations, maybe they're not going to do that either. So, and when we look at our data, as I said, you do see signs that people are doing less on discretionary retail. And the other sign we're looking for, but it's hard to find in terms of data, is are people, in the old days we used to saying now eating chicken rather than meat, but chicken's bloody expensive too. But are they sort of going downscale in terms of quality? So I think there are some issues out there. If we look at our forecasts going forward, though, we do still see continuous growth. Now, if you look at those red lines there, they're slowing. And it does take, in year average terms, our growth rates from 4 to 2, roughly, or through the year down below 2. But we're still growing in terms of our forecasts. The other slide that I used to put up just to make fun of myself in terms of trying to build models is this one. So we're looking at quarterly models, the same sort of thing as the US one. And sure, they don't work around when you close down half the economy. But if you look at the red lines there, which is what the model and our forecasts, which are in the black lines, are basically converging at around about 0.5 a quarter. They're not converging around 0, which is where we got in the US. So for us, we still see the Australian economy as slowing, halving from a combination of interest rates and slower global growth, but not stopping. And the other thing we see, I think I mentioned before, is we can get what we call the claimant count, i.e. the number of people that are being paid the dole in NAB, and then we put it across the economy. And the yellow line is the claimant count, and the blue line is the level of unemployment. So what we're seeing, and the official data is only to May, so our data is to essentially the end of June, it's saying that the labour market's getting even better. And that, from a housing point of view, is really important, because when you're looking at bad debts and things like that, it's the level, can you get a job, is really important. Much more so than interest rates, and much more so than the economy, although there are limits. I mean, the market's talking about 4% increase by Christmas. They get that, my model will drive down into a recession. But I don't think the Reserve Bank's silly enough to do that. So the final slide, and to give you 15 minutes of ability to ask me questions, in terms of the labour market anyway, is we do see unemployment starting, drops down to about 3.5. Maybe it won't get there straight away, but we'll just see. And then it might get back up to 4%. But it's still a pretty good outcome. And for us, when we look at the Reserve Bank, we've got them going another 2 lots of 50, then another 25, gets them to 210 by the end of the year. Doesn't have a big liquidity impact until middle of the year. The other thing we know when we look at our book, we see a big chunk of fixed loans maturing in the first half of next year. So that also sort of multiplies the liquidity impact. So if you're going to talk about liquidity rather than just I'm scared, it's the middle of next year. So that's when I think you'll be at the peak. And that's why I think that you'll be more worried. And that's why I think the RBA might be done by the end of next year. They're not going to keep going unless if they see the consumer starting to soften, and we think that probably will happen. But if I was going to summarize overall, economy is still doing okay. It is slowing. The world economy is slower. Interest rates are going up, but not to levels that are going to kill you. And what we're worried about is the consumer's reaction, because I don't think there's a lot of consumers who have basically been in an environment where rates are going up, their income's not going up that much, their electricity prices are high, and you can see a lot of potential things like some small electricity retailers that will fall over. So, Chris, I might stop there. I'll stop sharing my screen. And hopefully I haven't ruined everybody's lunch.
No, not at all, Alan. As always, the voice of reason, the voice of calmness. So thank you. And there was a lot to take in. And we've got some fantastic questions coming through. I just remind everyone, you've got the Q&A function on your screen. Please log some questions in and we'll do our best to get through them all. There's plenty coming. So perhaps, Alan, let's get into it. We'll have everyone out by 1, so we've got 15 minutes, fast and furious. So first of all, a question just in respect to the US.
Yeah.
How would a US recession impact Australia?
Well, what we've done is we put that into our models, and basically it's taking a quarter point or so off the growth momentum. So it's really important. Um, if the US does look like it's getting into a recession and the equity markets panic even more, then that has a bigger impact. But unless you tell me the US is going to stall and go backwards by -2 or -3%, we're okay, is basically the bottom line. And if the US does start to do that, there will be a lot of central banks who will be cutting rates rather than just increasing rates. So in the US, we've actually got rate cuts in 24 in our forecast.
Sure. And maybe a related question, just in terms of the markets, we've seen quite a correction in global markets and coming into our own ASX. How do you see the markets responding to everything that's going on?
Well, I think the reason that markets are responding is people are starting to think, Christ, the Fed might actually cause a recession here. And if you're in a recession, then that's not a good thing for equity markets. And then they also worry a little bit about what's happening to Russia and things like that. And so there's that issue that sell equities if you think a big economy is going into recession and the global economy is quite low in terms of next year and the year after.
Yeah, and just in terms, bring it back to Australia, just in terms of wage increases, as we're starting to see some of that play out, when does that start to take effect and impact consumer spending and confidence?
Well, the wage rises in the national wage case, most of them are from the 1st of July. So you will get a period that we think where you'll be getting an increase. Not all of them, about half of those average weekly earnings increases or awards apply from 1 September. So they're sort of staggered. It would help. But again, if you've got inflation running at 6.5 to 7, a lot of people are going to find even a reasonable pay cut is not going to make it easy for you in terms of managing your budget. And that's where they start to say, well, I won't take my holiday, I won't do my renovations, I won't go to the restaurant, I might buy, the dog gets tinned food rather than bones, all that sort of stuff. And we just have to watch that one. So wages, I think, will help. And, hopefully migration will help even more when we get some more people back. But at this stage, it takes time. And so last year on migration, we were getting, or a couple of years ago, before the pandemic, we were getting about 160 or 180,000 net new people living in Australia. We're net zero at present. We stopped going backwards, but that's about all we've got. So it's going to take a while before that picks up.
Do you think that on that very point, given I think everyone's feeling, that the crunch of not having enough people to do the work, do you think that there will be changes in government policy with the new government to accelerate the opening of the labour markets?
Well, I'd hope they would. I haven't heard anything yet. And, you do run into the risk that, you've increased immigration and people are just coming in and taking my job. So that won't go down well. But from an economic point of view, it would really help if you could get migration back. You can see it a little bit in education. I didn't put the education slide up because it's depressing, but it's better than last year. Let's put it that way. And so therefore there'll be more people renting out apartments in the various capital cities near universities. But also you need some spending. And, one of the risks might actually be that the Aussies basically decide to go overseas. And then we miss it completely. And the people that can afford that are the people that have got all the savings.
Yeah, sure. Maybe sort of just turning to business confidence and conditions. You've been doing this a long time. What do you put more emphasis on, conditions or confidence?
I put much more emphasis on conditions. In fact, the one I put most on is forward orders. But confidence, is a leading indicator. But what you have to worry about confidence is if it crashes, will it stay there or not? So it crashed during the sort of things that we're seeing during the virus, but then it bounced straight back. So, and you see that all the time. And I'm sort of looking at confidence and saying that's the only one that sort of is suffering a bit at present. But when I'm saying suffering, it's +6. And as I said, confidence in New Zealand is -50. So it's a very different story. And so business is saying, oh, stuff, I can't get my things, my profit margin's being killed, blah, 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 blah. I can't get my people, but I'm okay. There's demand there. Whereas they're more worried about whether that's happening in New Zealand or not.
Sure. And how do you see that playing, therefore, out in business investment, both in plant equipment, buildings?
So we and the government also run surveys about what are you going to do to capital expenditure in the next 12 months. They're high. So business is still saying things are, I want to invest. So if I can't get the people, I need better capital. If we look at business credit, it's running on our book at around 13% annualized in the last 3 to 6 months. Now we see it slowing to something like 5, but if I'm standing here honestly in front of you, have I seen any signs of it slowing in our book? No. So I think business investment plays a really important part in helping offset some of the slowdown that you're going to get in consumption as people feel like they're under the weather a bit.
That's good. And let's talk about our major trading partner in China. How do you see the factors playing out in China? They're still going through some lockdowns. They're having obviously you've mentioned the impact of their vaccine is playing out there.
Yeah. The main thing that we sell China is commodities. And the prices are through the roof. So its actual impact on us isn't as large as it used to be. So, there's not a lot of Chinese students coming still. And we are changing our supply chains. Now, they've still got problems in terms of tariffs, and they said they'd like to be nicer to us, but they haven't changed the tariffs at all. But the good news is we've sort of diversified away from China in a lot of these things. And in coal, you go to Europe and they're turning on their coal-fired power stations again because they're worried about gas. So I think Australia's in a reasonably good shape in that sense. Now, if China ups it again and if they ever figure out how to make steel without iron ore, that will be an issue. But, I think it's not going to be a big negative as we go forward. It's already been a negative for us, but in some extent because people forget Australia's a net exporter of energy. So when the energy prices go through the roof, the miners don't tell you, but they're having a great time. The farmers will never tell you. They're doing really well. They're complaining about the price of fertiliser, et cetera, but they're doing really well.
Yeah.
And so there's some sectors of the economy that are having the best years they've ever had. You don't hear that very much in the press.
Yeah. Just on our farmers, they've obviously had great years and provided, knock on wood, our weather holds. Does the situation in Europe, particularly around this concern around food security, sort of play into opportunities there for our miners?
Oh, it sure does. Yeah. So you see the wheat crop and you see the prices. So just remember, 20% of the total global wheat crop comes out of China and Ukraine. So now you've got a 20% reduction in essentially wheat globally. And so the price goes through the roof. It might cost you more to get your seeds and put your fertilizers on it, but the prices are really high. And so, lamb prices and all that sort of stuff is really high. So Australia is also a big exporter of food. We're never going to be, the food bowl for China. We're not that big, but it's going to help. And, farm GDP is up 12, 15% There's a good crop. It looks like there'll be a good crop next year. And so, yeah, it's a very good time if you're a farmer.
Interesting one here is, we obviously see the concerns in the construction industry about
Yeah.
supply chain driving up costs. We also see, to your point just then, that we're seeing great, growth in regional areas.
Yeah.
By opening up our borders, do you see, with more new Australians entering the market, the ability of regional communities to continue to attract?
I think that's right. And I also think that if they've got reasonable internet, a lot of people will want to work
Yep.
from home. And that's part of the reason why, if you put up house prices, non-capital cities shoots the lights out relative to capital cities. And so it's still, people. So I'm in Melbourne, so people in Geelong, that sort of area. If I'm in Sydney, the Blue Mountains. If I'm in Queensland, Noosa, Gold Coast, that sort of stuff. And then I run out of places because I don't know the equivalent in Western Australia and Tassie. But you know the sort of message that you're seeing. And there's a lot of wealth out there.
Yeah.
And there's a lot of shortages of staff. And so there's a lot of jobs.
Now, this one, just drawing back to, I guess, the fundamentals of lending, business and home lending. We've seen a dramatic rise in the cost of funds, and that's now starting
Yep.
to play through in business lending rates and home lending rates as well. Where do you see, I guess, the global markets taking liquidity and cost of funds?
Well, the cost of funds shows up most in Australia in the fixed book. So if you think about it, in 2 years' time, if I'm a bank and I want a 2% margin, the cost of funds is 4%. So the fixed loan for 2 years, I think pretty soon is going to have a 6 in front of it. So Australia is a little bit better in the sense that they mainly run off variable home loans. That is going up, but it's not such that it's going to kill you. And so we've assumed that, rates go 2% up from here. And we look through what it does. And in our book, it's roughly $300 a month, which is not small, but, it would roughly cancel out the pay rises you've got. But it does mean that it doesn't knock you over like, 18% interest rates used to do. It's not going to be catastrophic because the household balance sheet is still pretty robust overall. It's more that, the issue is, do consumers panic and say, woe is me, I'm not going to do anything? So as I think I've said before to you, Chris, there's something in economics called the paradox of thrift. We all save more, economy goes down the tubes because nobody spends. So, I think, and the banks are keen to lend because we don't see don't see any signs, to be brutally honest, of any stress out there as in defaults. And I'll tell you, we're looking a lot. We've actually employed more people for NAB Assist on the basis that we don't need them now, but we might need them in 6 months' time. But, the honest answer is we don't see it, and we think we're happy to keep lending to housing and construction and business generally.
Yeah, I agree with that. And I think that's a good way to conclude. Unfortunately, there's so many great questions and we haven't had the ability today to get through them all. And I think by far of the number of events that we've run with you, Alan, this has been the most well attended and the most questions asked. So I'd like to just say to everyone as we close today, a big thank you to Alan for making the time. Again, a very terrific session. Thank you. But on behalf of NAB, I'd like to thank all of our brokers and customers who joined us today for your ongoing partnership and custom. As a bank who promises to provide you with access to the best experts in the market, I hope you today found that we're able to provide you important insights that will help you in your job and in your business and with your customers. So I wish you a great day, and until next time, go well. Thank you, everyone.